Go interactive with X-Ray, where we bring trading experts to you live in the platform. Choose sessions, watch live market analysis, and catch up on your favorite market insights anytime. Ask questions and go one-to-one with leading experts on gold, oil, FX, crypto, indices, and equities. X-Ray, your very own analysis team, right at your fingertips. That's higher trading from MarketsX.
2020 was a difficult year for us all. World economies have crashed. Financial markets showed us again how important it is to be aware of the global economy. And, believe it or not, many people have profited from the movements in the markets. This December, we bring you the biggest open source webinar series for beginner traders to help each and every one of you understand the basics of online trading and investments from industry experts. Learn from the CEOs is the biggest webinar series organized by InstructFX with the extraordinary participation of 5 CEOs of 5 top Forex companies worldwide. Join us live on Monday, the 14th of December at 1700 GMT for the grand opening with an amazing webinar on trading currency pairs with João Monteiro, CEO at Forex. On Tuesday, the 15th of December, trading stocks and indices is the topic of the day with Phil Adler, CEO at ETX Capital, straight from the heart of London. Wednesday, the 16th, the week only gets better with Joe Rundle, CEO at Markets.com for an amazing webinar on trading commodities. Just when you thought that things can't get any better, on Thursday, the 17th, we have the cryptocurrencies trading webinar with our surprise guest. Finally, on Friday the 18th, it's your time to shine in the Fidelity Gala Awards, where InstructFX is rewarding you for watching us live with amazing prizes. Join the biggest open source webinar of 2020 and learn what most Forex brokers don't want you to know from 5 reputable CEOs. Click on the link below and reserve your seat for the biggest open source webinar of 2020, hosted by yours truly, Andrew, the Chart Whisperer. Learn, observe, trade with InstructFX.
What's happening, people? Good evening, everyone, and welcome to the biggest open source webinar organized by InstructFX. How are you guys doing, first of all? Please let us know if we have audio and video, guys. Type your comments in the comments box and let me know how the sound is and how the image is, if everything is okay. Also, please feel free to type any questions you have during the webinar in the comments section, and towards the end of the webinar we will have an open Q&A, and hopefully I get to answer any single question you have. Let me know how the sound and image is, guys. We're going to start the webinar in 2 minutes, so either type a yes or no in the comments box, either type a sentence. Let me know how the sound and image is so we can get started. We're going to start in about 1 to 2 minutes from now, guys. I'm just waiting for everyone to join. It takes a bit of time for everyone to join. We have quite a few registrations for tonight. Welcome to the grand opening, guys. Welcome to the grand opening. So let us know. Okay, we see more people joining us as we speak. This is how it goes. That's what I'm talking about. How is the sound? How is the image? All good there. All good there. Thank you, Alex. Thank you so much, Alex. All right. Well, until more people join us, guys, I'm just going to run an advert and we're going to start the webinar in about 1 minute. Stay tuned.
Join us live on Monday, the 14th of December at 1700 GMT for the grand opening with an amazing webinar on trading currency pairs with João Monteiro, CEO at Forex. Learn from the CEOs is the biggest webinar series organized by InstructFX with the extraordinary participation of 5 CEOs of 5 top Forex companies worldwide. Join the biggest open source webinar of 2020 and learn what most Forex brokers don't want you to know from 5 reputable CEOs. Click on the link below and reserve your seat for the biggest open source webinar of 2020, hosted by yours truly, Andrew, the Chart Whisperer. Learn, observe, trade with InstructFX.
Right, and we're back with more people and with your comments. Thank you for your comments, guys. Good evening, everyone, and thank you all for attending this webinar. 2020 has been a difficult year for us all. Financial markets have crashed. World economies are suffering. But believe it or not, many people have profited from the movements in the markets. This December, InstructFX, along with 4 reputable Forex brokerages worldwide, brings you the financial markets to your doorstep in a marathon week, where we break down all the 5 asset classes with the help of 4 CEOs that decided to share their knowledge with you guys. The 5 most traded asset classes in the CFDs markets will be explained to you this week every evening, same time, same place. And on Friday is your time to shine in the Gala Fidelity Awards, where InstructFX is rewarding you for watching us live and learning. We start the series this evening with probably the most traded asset class in the world, which is Forex trading. Tomorrow night, we're going to have stocks and indices with Phil Adler, CEO at ETX Capital, straight from the heart of London. Wednesday, we're going to have Joe Rundle, CEO at markets.com, for a great round of trading commodities. Thursday, cryptocurrencies take the stage with my surprise guest. And Friday, guys, is the day when we reward you for learning. Let's get started, first of all, with the most traded asset class in the world, guys, which is Forex trading or currency pairs. If you have any questions, if you have any comments, type your comments in the comments box, and I will do my best to answer all your questions towards the end of the webinar when we have the Q&A session. Are you guys ready? Shall we get started? All right. You can type the comments yes or no. If you want me to get started now, type a yes. If you don't want me to get started now, type a no, and I'm still going to get started. So Forex trading, guys, this is the opening. This is the opening to the marathon week that we're going to have, and we start with the most traded asset class in the world. First of all, for compliance purposes, guys, we have to read the disclaimer. All information presented during this webinar is from public sources and should be treated accordingly. Our content is intended to be used and must be used for informational purposes only. It is very important to do your own analysis before making any investment based on your own personal circumstances. You should take your own financial decision or independently research and verify any information that you see and wish to rely upon, whether for the purpose of making an investment decision or otherwise. We would like to draw your attention to the following important investment warnings. The value of shares and investments and the income derived from them can go up as well as down. Investors may not get back the amount they invested, and past performance is not a guide to future performance. This is the disclaimer, guys. Now that we're all legit, we can crack on with the presentation. I know tonight I was supposed to have João Monteiro in the studio. He called me about 1 hour ago, 1 hour and 20 minutes ago, telling me he's stuck in traffic because it's heavy rain and probably there were some accidents on the highway. But as soon as he gets home, or if he gets home in time, he will join us live. Okay, my apologies for João Monteiro not being able to make it. His story as well, but he is trying, guys. So hopefully the highway is clear. He's gonna manage to get home and join us in a few minutes or any minute now. Now let's start with the presentation, guys. I see more people joining us. Good evening, everyone, and welcome to the biggest open webinar source of 2020, organized by InstructFX. So let's get started, guys, with slide number 1. We have to understand, obviously, what is Forex, guys? What does Forex stand for? It's very easy, very simple. Forex trading is the act of buying or selling currencies. Banks, central banks, corporations, institutional investors, and individual traders exchange foreign currency for a variety of reasons, including balancing the markets, facilitating international trade and tourism, or aiming to make a profit. The market determines the foreign exchange rates for every currency. This includes all aspects of buying, selling, and exchanging currencies at current or determined prices. In terms of trading volume, Forex trading is by far the largest market in the world, with a daily turnover of over $5 trillion, guys. This is what Forex stands for. Foreign exchange, guys. Currency pairs, currency trading. Let's move on to the other slide, guys, and understand what are we doing here when we're trading online. Okay, we are trading contracts for difference, CFDs. You're going to hear this term quite a lot. You need to know what it means. A contract for difference, or CFD, is a contract between two parties, typically described as buyer and seller, stipulating that the seller will pay the buyer the difference between the current value of an asset and its value at contract time. If the difference is negative, then the buyer pays instead to the seller. When trading CFDs, and this is very important to note, guys, when you're trading CFDs, you're not owning the underlying asset. You don't own that asset. You're just trading on the price movement up or down. For example, where will the price of gold be in the next 5 hours? If you have a reason to believe that gold price will go up from the current market price, you might want to go in with a buy position. If you think that gold price might go down for some reason, you might want to go in the market with a sell position, but you don't own the underlying asset. Okay, you're just trading on the price difference. The profit is realized by predicting the future price movement. The movement upwards is called a buy. The movement downwards is called a sell. This is what CFDs are. This is what CFDs stand for. Yeah, contracts for difference. Right, let's move on because we have quite a few slides tonight. Guys, Forex trading is complex. Okay, and tonight we're going to touch upon most topics. Yeah, but there's still a lot of things we need to talk about. And I'm more than happy to do that in private sessions or in the following webinars. Now, how CFDs work, very important for everyone to understand. Let's say, for example, crude oil is currently trading at $50 per barrel, and it is, guys. I did the New York, the American market opening a couple of hours ago, and indeed, crude oil is trading at $50 per barrel. Let's say a trader opens a buy position and oil price moves up to $55 per barrel in the next 4 hours, let's say. At this point, the trader who bought is in profit and can close the trade and cash out, as easy as that. If the trader would have opened a sell position thinking that oil price will go down, but instead the oil price goes up, now his position would now be in a loss, and he can either close it and accept the loss or keep it open and hope for the price to turn around, yeah, or go down, go in his favor. You have the options. Yeah, the option is yours. Whenever a trade doesn't go your way, you can either wait for it to turn around, as we're going to see on the charts. Financial markets do turn around quite a lot. Or you can just call it for the day and close the trade with a bit of profit. It's not the end of the world, guys. It happens all the time. Everyone does that, including myself. When I see a trade doesn't go well and I see the market has absolutely no chance in going my way soon, I'd rather take a loss than increase that loss. Yeah, in case the markets goes against me, or I didn't place a stop loss. We're going to talk about stop loss and take profit in the next slide. So this is how CFDs work, guys. Okay, we don't own the underlying asset. We're just trying to predict where the price will be in the next few hours or in the next few days, higher or lower than the current market price. Let's move on. You can type your questions, guys, if you have questions. If you don't understand anything, if you want me to speak slower or faster or louder, let me know. Type your comments, guys. Let's move on to the next slide. See some Forex characteristics. Now, we have a lot of Forex brokerages out there. A lot of Forex brokerages. So they are regulated in various jurisdictions. Okay, around the world. Some jurisdictions are more permissive when they allow a leverage of 1 to 400, let's say, typically the offshore jurisdictions. We recently saw European regulators, some Asian regulators, and the Aussie regulators as well, dropping the leverage. They all used to have 1 to 400 till very, very recent, and they decided to drop it to 1 to 30. So, subject to regulation, the leverage in the Forex market can vary between 1 to 30 up to 1 to 200 or 1 to 400, depending on which area of the world your brokerage is regulated. Now, the trading hours for Forex are more or less 24/7. I'd say 24/5 to be precise, Monday to Friday. Over the weekends, the market stay closed. And also after midnight, guys, there's going to be a 1 hour break. Yeah, between the U.S. Trading session and the opening of the Asian trading session or the Australian trading session. Yeah, there's going to be about an hour break. Now, unlike other asset classes, Forex, currency pairs do not have an expiry date, guys. Okay, not like binary options, for example, where your trade expires within a certain amount of time. Forex trading hasn't got an expiry date. You can trade them all year round, 24/5, Monday to Friday. Advantages of trading Forex, guys: high leverage, high volatility, and no expiry date. These are the advantages. Now, the bounciest asset class in the world are currency pairs. Let's move on to the next slide and see other Forex characteristics. It's huge trading volume, representing the largest asset class in the world, leading to high liquidity. The most liquid asset class in the world is Forex trading, guys, currency pairs. It's geographical dispersion. You can trade Forex all over the world. Okay, there are very small restrictions, like North Korea, for example, or America. But apart from that, you can trade from any place in the world, and everyone is participating into the Forex market, as you're going to see in the next couple of slides. It's continuous operation, 24 hours a day almost, except weekends. Trading from 2200 hours GMT on a Sunday when Sydney opens until 2200 hours GMT on a Friday when New York closes. Yeah, this was the gap I was telling you about. The variety of factors that affect exchange rates and the use of leverage to enhance profit and loss margins. These are just a few of the Forex characteristics. Again, guys, type your comments. Let me know what you think. Let me know if you're struggling with anything or if you understand everything. Right, let's move on to the next slide. What is leverage, guys? I keep mentioning the word leverage, and some beginner traders simply don't know what leverage is. Leverage is a very useful tool that allows traders to trade multiple times the amount they deposited in the trading account. In the foreign exchange markets, leverage is commonly as high as 1 to 200 or 1 to 400, guys. This means for every $1,000 in your trading account, you can trade up to $200,000 in value. Yeah. In other words, if an asset has a leverage of 1 to 200, you will have to invest 200 times less as collateral. Yeah. So the higher the leverage, the less you're going to have to invest to trade on that asset. However, guys, leverage is a double-edged sword. The trade might go against you and fast. Okay, so think twice. But it's good to know what leverage is and how to use it. If leverage is used properly, then you have no reason to be worried about. Let's move on to the next slide. Who are the market participants? I was telling you a couple of minutes ago. You are a participant in the Forex market. Either you want it or not. It happens. The main market participants in the Forex market are commercial companies, central banks, investment management firms, retail foreign exchange traders, non-bank foreign exchange companies, tourism, private businesses, money transfer or remittance companies, and bureaus, the exchange. Okay, so everyone is participating in the Forex market, either for a profit like traders do, either just, let's say you work for a company in the US, you live in Europe, and that company is paying you in the US dollars. Yeah, your salary is based in US dollars, but you live in Europe. So you're going to have to exchange your salary into the currency where you live so you can actually use it. Now, let's say you have a salary of $5,000 a month. And again, you live in Europe. Will that $5,000 mean the exact same amount in euros every month? No. That's foreign exchange, guys. That's how foreign exchange works. So everyone is a participant. Some people choose to make a profit out of it. Some people just decide to look at other people making profits. Now, this is your decision, but believe it or not, as long as you have a credit card, a debit card, a salary, you are participating in the financial markets. Let's move on to the next slide and see what else is going on. We still have about 10 slides to go, guys. How does it work? Very, very simple, guys. Very, very easy and very, very simple to understand how Forex works. Buy low and sell high is the common practice of buying an asset when its price is low and selling it at a higher rate. Okay, without owning the underlying asset. The ability to buy low and sell high requires one to be able to determine roughly when the low and high prices for the security occur. Okay, very easy, very, very simple. This is how it works. You're looking to buy after a big drop on the market in hope for the price to go up, or after a good rally of the market, you're looking to open a sell position, again, without owning the underlying asset, in hope for the price to go down. And this is how you capitalize on it. Now, Next slide. There we go. Another example. Yeah, the most liquid currency pair in the world, the most traded currency pair in the world, the euro US dollar. A widely traded currency pair is the euro against the US dollar. In fact, it's the most liquid currency pair in the world because it's the most heavily traded. The quotation euro USD equals 125 means that 1 euro is exchanged for $1.25. In this case, the euro is the base currency, yeah, and it's placed in the left-hand side of the currency pair. And the US dollar is the quote currency or the counter currency. So this means that 1 euro can be exchanged for $1.25. Another way of looking at this is that it will cost you $125 to buy 100 euros. It's not difficult, is it? As easy as that. Let's move on to the next slide. What do you need to trade Forex? Many people might think they're not prepared to trade Forex. They don't have what it takes. They don't have what's necessary. You don't need a lot, guys. You need a trading account, obviously, which is provided by a brokerage. That's what the brokerage does. That's their job, basically, yeah? To be the tampon between the bank, yeah, the liquidity provider, and the retail trader. And to offer retail traders a trading platform. And this is what a brokerage does. So you need a trading account. You need a bit of funds, guys. Yeah, whatever. Anything started from $250, $500 and up. You need a laptop, a PC, a tablet, or a mobile phone. Yeah, preferably you should start, if you're a beginner trader, you should start on a laptop or a PC or a desktop. Yeah, because the screen is much wider and you understand better what goes on. But you can easily trade Forex on a tablet or even on your mobile phone. I trade on my mobile phone sometimes. You need an internet connection, a good internet connection, and that's vital. And you need a valid ID or passport and proof of residence. Why? Due to the AML policy. Yeah, the AML policy is a world directive for financial firms that to require a proof of ID and a proof of address. Yeah, bank statement, whatever, can be used. Yeah, a passport or a national ID can be used as a proof of ID. And a proof of residence, you need a utility bill, preferably on your name, no older than 3 months. This is it. This is what you need to get started. Now, from the point where you get started, you have a lot of options around you. You can choose to learn. You can choose to dive straight in the water and play a bit with $250 or $500 and see where that's going to take you. Or you can choose to do what we do here at InstructFX and what we encourage all our clients or our traders to do: learn, observe, and trade. Yeah, start by learning, then spend a bit of time observing the movements of the markets, trying to predict what's going to happen, and then trade it, guys. That's why you've learned and observed, so you can trade it. All right, let's move on. I see we have a couple of comments, guys. I'm going to take the questions in a few minutes towards the end at the Q&A session. Now, I just want to move on with the presentation because we have quite a few slides. Advantages of trading Forex online, guys. There we go. A few advantages. Leverage, first of all, is a very useful tool that allows traders to trade multiple times the amount they deposited in the trading account. As mentioned a few minutes ago, in the foreign exchange markets, the leverage is commonly as high as 200 to 1 or 400 to 1. That means for every $1,000 in your account, you can trade up to $200,000 in value. Now, focus a bit on the right-hand side of the screen, guys, where you see that trading platform, and I'll explain to you the example. Yeah. So we're look below, yeah, at the box in the left-hand side below there. You're going to see 100,000 in the box. That can mean 100,000 euros, $100,000, or one lot. Right? Below that, you see initial margin. What is the initial margin there? It's $278. Okay? So for you to open one lot or to trade 100,000 in value, you will only have to invest $278. Yeah, this is a euro US dollar. Okay, so $278 at that point meant 250 euros. So that tells me the leverage on that trading account is 1 to 400. Yeah, if you divide 100,000 units, which is the amount you're trying to trade, yeah, by 400, which is the leverage, you will get your initial margin, your initial investment. How much do you have to put in as collateral to be able to open a buy or sell on that trade? Quite impressive, isn't it? Other people just run to the bank with 100,000 euros in cash and they exchange it into US dollars. And then next day they do the same thing. They run to the bank with the dollars, exchanging it back into the euros and making profit the difference between the exchange rate. Isn't it easier if you just trade online? Right, it is for me. Now, look towards the right-hand side again of the chart. At the top, you're going to see a sell arrow pointing downwards. Now, I'll explain to you the logic and how it works. Let's say for a number of hours here or for a couple of days, I've witnessed this upwards movement from the euro. Yeah, I saw euro strengthening and strengthening and strengthening. And experience tells me that whatever goes up must come down, and whatever goes down must come back up. This is how it works. Yeah, and another way to look at it is we're not only looking at the euro versus the US dollar, guys. We're looking at the economies of these two continents. Yeah, Europe and the US. So what will happen if today the exchange rate is 112.13, let's say, and tomorrow the exchange rate jumps to 125 something? The entire mechanism will be flipped. So that will affect the economy of both countries, the exchange rates. Yeah, both countries, both continents are doing imports and exports every day. Yeah, you can't have a difference in exchange rate that high, that fast. Yeah, that will completely destabilize the entire world. So coming back to the example, let's say I saw the euro going up for a few days, and experience tells me whatever comes up must come down. What am I going to do? I'm going to be aiming for a sell position, for an entry on the market with a sell position. So basically I'm saying, right, from this price, I think the price will go down. It will go where it was before. Yeah, and as you look towards the bottom of the chart, you're going to see a take profit area highlighted in red. After I open my sell position, I know it's only a matter of time until the price will go there. So after I open my sell position, I'm going to set a take profit, guys. What does that mean? Whenever that price will be reached, my position will close automatically with whatever profit I've realized till then. As easy as that. You might not get it right. It might go the other way. It might go higher. And that's why you have the tools that I'm going to show you in the next couple of slides to try and protect your account as much as you can. All right. Now, let's move on. Talking about the tools, let's move on to, first of all, the disadvantages of trading Forex online. This is exactly what I mentioned a second ago. An early or late entry could leave the trader exposed. The market is unpredictable, and not enough flexibility in the account could lead to losses, could lead to a stop out. What does that mean? Let's say, again, look towards the right-hand side, yeah, at the chart. Yeah, let's say at that point where you see the red arrow, for whatever reason, I thought the downwards movement will continue. Yeah, this is a 4-hour chart, guys, of GBP CHF, which means every green or red candlestick you see there represents 4 hours. Yes, so it's going to take quite a bit of time. So let's say for whatever reason at that point, I thought the pound will go lower, and I opened the sell position and I set the take profit obviously lower, yeah, than my entry, because when the price goes down, I want my trade to close automatically and cash all that profit. But the market was funny. It went up. At this stage, I could have protected my account with a stop loss. Yeah, somewhere there in that region, above my sell position. A stop loss kind of prevents me from losing money if the movement of the market is against me, if the market goes the other way. Yeah, so I could have set a stop loss there. I decided not to do that. So now at this stage, my account would either blow up or show quite a bit of a loss. There is a good news though. Even if that happens, there is a good news. While your position is open, you didn't lose anything. You didn't make anything. Yeah, the loss occurs on the trading account, or the profit occurs on the trading account only when you close that position. While you're on the market, today you might see your account losing $2,000, potentially losing $2,000 if you're closing that position. If you keep it open and you have enough flexibility and enough margin, and you decide to keep it open, by tomorrow you might be $2,000 in profit, because you see what the markets are doing. You see what the charts are doing. The price is going up and down every single day, guys. Right, let's see what's happening. We have some more some more thank you for the nice words. Okay, I'm gonna take the questions, guys, and I'm gonna reply to that towards the end of the webinar. Now I just want to move on with the presentation. We still have a few slides ahead of us. Price patterns. Many people were telling me trading is very difficult, it's very complicated. No, it's not. You only have two price patterns, guys, and you're gonna see there is a potential third one in the next slide: a downtrend or an uptrend. When the asset decides to go up and down in price, following some events, okay, these are the only two directions the price can go, up or down. It will take a few days for the price to go down. It will take a few days for the price to go up. But ultimately, this is the movement. This is the prime price pattern, a downtrend or an uptrend. If you look at the charts the right way, if you're using the correct time frames, then these patterns can be quite predictable. And now let's move on to the other pattern that I was telling you about, a ranging market, when the asset basically refuses to trade higher or lower. It has a range, and this is it. A trading range occurs when the asset or security trades between consistent highs and lows for a period of time. The top of a securities trading range often provides resistance, while the bottom of the trading range typically offers price support. You will hear about it, or you might have heard about it already. Support resistance levels. These are the support and resistance levels, guys. The average lows and the average highs at which that asset is trading on. As easy as that. Simple, isn't it? Okay, so these are the price patterns, guys. An uptrend, a downtrend, or a ranging market. You can take advantage of an uptrend, you can take advantage of a downtrend, and you can take advantage of a ranging market. If you're looking at the charts on the correct time frame and the ranging market allows you to enter the market and exit and hopefully get some profits from it, why not? I don't see why not. The USD CAD, I'm gonna give you a tip. The USD CAD, guys, if you look at it at the correct time frame, we'll see that it ranges for very long periods of time. And so do other asset classes as well. Right, let's move on to slide number 17. We're getting close to the Q&A session, guys. Choose the direction, buy or sell, hedge, buy or sell, and take profit and stop loss are optional, guys. These are the trading strategies, basically. It's not rocket science. You choose the direction, either buy low and sell high. Or sell high and buy low. You can hedge your trades. I'm going to go into hedging. Hedging is a different strategy, meaning buying and selling the same asset in the same time. Or you can hedge a buy position on an asset with another trade on a different asset that's not connected to the first asset. I know it sounds complicated, and that's why I'm not going to go into it deeper tonight. Take profit and stop loss are optional, guys. It's your call if you want to set a take profit target for your trades, or a stop loss to protect your account from blowing up, or from getting into a margin call, for example. All right. Okay. Let's move on to slide number 18, and I'm going to show you how take profit works. If you're watching my daily live broadcast, guys, the market opening, you're going to see that very often I'm talking about that's where traders will very likely set their first take profit target for the upside or for the downside. Well, tonight I'm explaining to you what I mean by saying that. So, trading strategies. Let's start with choosing a direction. Let's say buy. When you're looking to open a buy position. A buy position is taken when the trader considers the market in a trend and expects the movement to last for at least a few hours. Very important. Please note that the time frame used in this case is 4 hours per candlestick. Therefore, the movement is expected to happen over at least 2 trading days, or 5 to 7 candlesticks. T0, 1, 2, and 3 are the target price for the take profit levels. In this example, T0 is the closest to the current market price that only aims for a short entry exit in case the downtrend will continue. If the reversal starts, then you can target T1, T2, and T3. So, let's say you saw the downtrend happening for 1 day, for 2 days, for 3 days, for 5 days. You know it can't go on forever. What will you do then? You will look for an entry point for a buy position. And if you look carefully, you can see that after every sharp drop, there is a correction of the market. The price pushes a bit higher. All right. Usually up to the 50% correction level. So In this case, for example, if I decide to go in with a buy position, aiming this correction, I don't know if the correction will go all the way up to the T1, to the first target. So I'm going to be cautious. I'm going to play it smart. I'm going to set a take profit halfway. Why halfway? Look at the previous movement, guys. Look at the previous movement. We saw a big drop. We saw the market ranging for a couple of days, I'd say, from what I see there. And then we saw correction happening. And that correction happened exactly to the 50% mark of that drop. Look at the big drop that you see from T3 all the way down. Big drop, followed by a correction. In this case, the correction was a bit above the 50% mark. But I like to play it safe, for example, and so can you. So don't aim for huge profits. Aim for what makes sense. Aim for logic. So this is the T0, T1, and T2. If I see that the price keeps pushing through my T0, there's nothing stopping me to move my take profit higher and make it a T1, or there's nothing stopping me from opening an additional buy position, setting as the take profit for the second position the T1 target. And so on, you have various trading strategies. Now, for the sell position, guys, again, very important. Let's say you've looked at an asset that went higher and higher and higher in price for quite a few days. You look towards the left-hand side, you see it reaching the same level it had in the past. What happened when it reached the level it had in the past? It started dropping, so you start thinking, right, after a good rally, what am I looking to do? Very likely sell. Because traders that opened buy positions down there are now closing their buy positions, cashing out the profits. So whenever that happens, you're going to see a meltdown. You're going to see this pullback, this correction that I'm telling you about. You do the exact same thing. You can enter the market with a sell position after the rally, targeting a small correction of the market. Who knows, maybe the uptrend will continue. So you want to play it safe. So you set your take profit to T0, which is half of the leg, half of the first movement. Half of the rally you see there, you can set your T0 for the sell position halfway. If the asset starts dropping and exceeds the T0, then again, there's nothing stopping you from moving your take profit or opening an additional position. At least now you know or you understand where you're standing with your trade, what the market is trying to do. Make sense? All right. If it doesn't, type your comments, guys. Type your questions. I'll do my best to go over them once again. Right. Let's move on with the take profit and the stop loss, guys. Very, very important for beginner and experienced traders, because in my 10 years of career, I've met a lot of experienced traders with years and years of experience that have no idea how to use a stop loss or a take profit. So this is the example. The take profit is the target price for closing your position in profit automatically whenever that price is reached. And the stop loss is the target price for closing your position with a loss if the trade moves against the trader. Okay, but you're not going to get your account blown out. You're only going to lose a small amount that you decide. So let's say in this case, we're looking at the open buy. Let me make the chart a bit bigger so you can see. There we go. So we're looking at the open buy when, let's say in this case, I decided to open a buy position, for example. Now, I'm going to set my take profit 0 and the take profit 1, for example, to the upside. And also, I'm going to set a stop loss, to the downside. What does that mean? As soon as I open the buy position, that's it. I'm on the market, guys. So I'm hoping for the price to go up. What I don't want to happen is for the price to go down. The trouble is, whenever the price goes up, if you're on the right side of the trade, you're making money. Whenever the price goes down, it starts chewing from your balance. It's eating from whatever you have in your trading account. So obviously, when you get to 0, that's it, game over, insert coin. You don't want that to happen, guys. So you can use a stop loss for that. As long as you use the stop loss and the take profit the right way, then you will increase the chances of being successful on the long run. Okay? You might get a dodgy trade here and there, but on the long run, if you know how to use these tools properly, you will increase your chances of being successful. Right, let's move on, because I don't know, I think we have 2 or 3 slides, and this is it, and then I can take the Q&A, guys. So, what did we understand after these 42 minutes? We understand that the markets, the financial markets, only have three big trends, guys: a downtrend, a ranging market, and an uptrend. On many occasions, you will see, if you look at the charts, at any trading chart, at any trading platform, the right way, you will see that whatever goes up must come down, and whatever goes down must come back up. But in between, the price will take a breather, will take a bit of time to catch its breath. This is how it works. Not really, really complicated. Slide 23, how to trade currency pairs, guys, because this is where it gets complicated. You have so many currency pairs out there. Oh my God, what are you going to trade? These were the questions that beginner traders were asking me, and they still ask me every day when we have the training sessions. How to trade these currency pairs? It's very, very easy, guys. You're trading the US dollar versus all its other peers. As easy as that. An easy way to look at it. Once you gain more experience, once you know what you're doing, you can diversify. You have minors, you have exotic currency pairs, you have many, many currency pairs. But for beginner traders, just see it as the US dollar. That's it. All right. Okay, we're very close to the Q&A, guys. Hi, Amir. Good evening. So, example one, if you have an indication that the US dollar might strengthen and you wish to diversify your positions, you can buy the currency pairs that have the US dollar in the left as the base currency. And we're looking at only a few examples there. USD JPY, USD Canadian, USD CHF. What do they have in common? They all have the US dollar as the base currency. So if you were to open 3 buy positions, buy USD JPY, buy USD CAD, and buy USD CHF, you're basically betting on the strength of the US dollar. When the US dollar strengthens, it strengthens against all its other peers, not only against one currency. Those strengths that you see only against one currency are usually triggered by events. Yeah, by some economic data that came out from that country, and obviously that currency versus the US dollar is losing or gaining value. But in general, when we're looking at the big picture, the US dollar weakens or strengthens against all its other peers. Now, in the next slide, let me see where the next slide is. There it is. In the next slide, example 2. If you have an indication that the US dollar might weaken and you wish to diversify your positions, you can buy the currency pairs that have the US dollar in the right-hand side as the quote currency. Okay, so Euro USD, GBP USD, Aussie dollar versus the US dollar, and the Kiwi dollar versus the US dollar as an example. Yeah, there are only 4 of the many examples that I can give you tonight. So what do they all have in common? The US dollar is in the right-hand side, so it's the quote currency. And if the dollar will weaken, what does that mean? The euro, the pound, the Aussie dollar, and the Kiwi dollar will strengthen versus the dollar, right? Right. There is another way you can trade it, the third way, if the first 2 don't make sense for some reason. If you have an indication that the US dollar might weaken and you wish to diversify your positions, you can sell all the pairs that have the US dollar in the left, like USD JPY, USD CAD, and USD CHF. Very, very simple, very, very easy. Why is that important, guys? They will not move. The US dollar will not move the same amount of points versus the other currency. The movement will not be identical. If you only trade USD JPY, guys, you might only make $10 profit. If you trade USD CAD, you might make $100 profit, as the movement will be more aggressive. If you trade USD CHF, you might make $45 profit, as the movement is halfway aggressive than it was on the USD CAD, but more aggressive than it was on the USD JPY. So diversifying your positions, could ultimately help you get better results. Makes sense? Is that logic? All right. If you have something you don't understand, guys, type your comments, type your questions, and we're going to take the questions shortly. There we go. Now we're talking. Let's take some questions. We had a few questions. Now, note to everyone, I'm streaming live on 3 different sources. You might not see all the questions that pop up, okay, on those sources. So I'm going to tell you, I'm going to try and choose the most, let's say, eloquent questions to the topic today. All right. And now, Alex, thank you so much for the kind words. Joby, thank you for the kind words. Alex, once again, thank you for the kind words. And Amir, very good evening, Amir. Now, let's see. What questions did you have, guys? Let me take some questions. Right. Let's take a question from Rob. Thank you for the explanation, Andrew. That's a good one. How much money do I need to start trading and what can I expect from that? That's actually a very good question, Rob. Only what you can afford to lose, professionals will say. All right. Obviously, the whole point and the purpose is not for you to lose money, Rob, but whatever you can afford. Okay, the minimum is $250 or $500 for most brokerages. I would not encourage anyone to go lower than that. I've seen brokerages taking $10 as the first deposit, taking $1 as the first deposit. Guys, it doesn't make sense. So I'd say a minimum 250 and upwards just to test the waters. Once you understand how it works, then, and once you understand what your expectations are from that amount, then you can talk about a proper investment. To answer your question, what could you expect from that? Rob, it's very difficult. The more money you have in your account, the lower the percentage will be. I know it doesn't make sense at a glance, but trust me, it does. So when you have a small trading account, you're gambling it more often, because you have to open certain positions, and unfortunately the minimum position you can open on most platforms is $25 per position. Now, how much can you expect from that? Only God knows, and what your trading strategy is and how lucky you are if you're a beginner trader. You might make 10, 20, 30% a day. You might make 30% in a month. You might make 100% in a month, but that's borderline gambling. So this is how it goes. The lower the amount you have in, then the higher the percentage, but the riskier it is. The more money you have in your trading account, then the less you're going to expose from it. That's how you're going to be on the safer side of things. There's no safe side 100% in trading, but you have very aggressive, very risky, and less risky. So having good flexibility in your trading account, good balance, and exposing very, very little from it, 2%, 3%, 5%, let's say, then what are the odds for you to get wiped out? Versus someone with $250 that gambles half of his trading account on a couple of trades. So this is your answer. Right, let's move on. Let's take another question again. Guys, now is the time. Type your questions, type your comments if you have comments or questions. Let me know how I'm doing. Let me know what you think. Right. I'm going to take this one, although many presenters will avoid it. Siabonga says, I think Forex is a scam. Siabonga, my friend, my job tonight here is not to persuade anyone of Forex being a scam or not. My job is to show you and explain to you how Forex works. Okay. Obviously, it would be very difficult to explain how a scam works. Okay. But if so many people are doing this for a living, I've been doing this for the last 10 years, mate. I've worked in many retail and institutional Forex brokerages in Europe. Forex itself is not a scam. I think you're probably talking about scammy companies. Okay. Companies that operate without a license, and that's a different story. Okay. Tonight, I'm just explaining Forex and how Forex works in the legit legal environment. You can see the disclaimer I have at the bottom of the screen, and you can also see the disclaimers I have in all my posts. Let's move on to Pavel, which is saying, I didn't understand leverage. Why is it different? Right. Leverage, right, is a tool that you use. That's why you're using a Forex broker. Because the Forex broker provides you two vital things. One, the trading platform, and two, the leverage. Okay, so the higher the leverage, the less money you have to put in as collateral. This is how it works. Okay, let's say Euro, US dollar, whatever, has a leverage of 2 to 1, and you want to trade 100,000. What does that mean? You only have to come up with 50,000, because you have the leverage of 2 to 1. So this is how leverage works. That's why online trading is so popular, because companies are offering leverage. Forex trading platforms worldwide are offering leverage. And leverage helps the average traders, the average people to trade. I don't know how many of us or how many of you have $100,000 to trade with and to spend. In case you lose it, you might lose it. It is what it is. How many of you or how many of us can say, I can spend $100,000 just like that? Not many. But You could trade $100,000 with the use of leverage. And you can trade $100,000 with only $500, only $1,000, only $250 if your leverage is 1 to 400 and 1 to 200. This is the difference. And the leverage is different based on regulation. Every country has financial regulation. Now, in Europe, we are privileged because we have the European regulation. And that applies in all the European countries. But you might have countries like, I don't know, South Korea, for example. That has a local regulation. Okay, so the leverage is different, subject to regulation. Right. Let's take another question. Guys, it's getting late. We're in the last 5 minutes. Let's take a few questions. Someone else is asking, why can't I make profits? I always have 2-3 trades that make money and then account gone. Why is that? What's your trading strategy? I don't know. I don't have all the details. What's your trading strategy? Who you're trading with? Maybe you're trading with a dodgy broker. God knows. Maybe you're doing binary options. I don't know. You have many answers to that. You don't have consistency in trading by the sounds of it. What amount are you trading with? Try a different strategy. If whatever you're doing now doesn't work, try a different strategy. It might work. Drop me an email. Let's see what we can do. Maybe we can have a training session together and I can help you a bit more. Right, Dennis from South Africa. Good evening, Dennis. It's been a while. Do you provide mentoring, Andrew? I want to learn more from you. You are already my client, Dennis. How are you? Good evening. I know you're trying to help. Is much appreciated. Yes, I do provide mentoring. Drop me an email if you need a bit of help, guys. And good news, InstructFX is providing free mentoring for everyone that needs it. Right. Let's take one last. Okay, it's not a question, it's a statement. I like it. We'll be back tomorrow night. Thank you, Andrew. Thank you so much, Karen. It's been a real pleasure. And I'm happy to help. Right. Let's take one more question. Joby is asking us, what is your opinion on the dollar CAD? I've been eyeing it since a huge drop, but just when I think it won't go lower. Surprise. Right. We need to do some chart analysis for that, Joby. Okay, it all has to do with the US dollar, with the stimulus measures. Watch my daily broadcasts. 2:30 GMT every day. US markets opening, and I'm doing an analysis on the USD CAD. Okay, it all has to do with the strength of the US dollar, with the stimulus measures, and with the COVID pandemic that's happening in the US right now and all over the world, and so on. Right. Guys, ladies, gentlemen, traders, thank you so much for your patience tonight. Contact us at instructfx.com, info@instructfx.com, or if you wanted to speak with me directly, thechartwhisperer@gmail.com. Thank you so much for being with us tonight. We're going to come back tomorrow night, guys, with another great round of market talks with Bill Adler, CEO at ETX Capital, straight from the heart of London. And stocks and indices is the topic tomorrow night. Don't miss out. Until then, remember to trade responsibly and may all your trades be in the money. Have a good evening, guys.